We are witnessing a synchronized signal that the financial markets were never supposed to send. In a span of just 72 hours, a trifecta of impossible events struck the global economy. First, the American dollar stumbled to a 4-month depth. Second, gold shattered the psychological glass ceiling, crossing $5,000 an ounce for the first time in recorded history. But the third event is the one that should keep you awake at night. For the first time in 3 decades, the ledger has flipped the world. As central banks now officially possess more wealth in physical bullion than they do in the United States. Treasury bonds. We aren't looking at random market noise or a fleeting dip in the charts. What you are watching is the bedrock of American financial hegemony cracking apart in real time. Here at the Economic of Fallen Empires, we study the anatomy of collapse, and the most terrifying variable right now is not the what, but the when. History usually moves slowly until it doesn't. Rome's currency debasement took 2 centuries to destroy the empire. The British pound sterling needed 30 years after the First World War to surrender its crown as the global reserve, the US dollar. It is achieving that same level of disintegration in just 30 months. We are tracing a line from the first fractures in February 2024 to the total abandonment of treasuries by January 2026, 30 months. That is the blink of an eye in economic history. We are currently standing at the halfway mark of the most aggressive monetary reset the modern world has ever seen. Over the next 25 minutes, I am going to decode exactly why this 18-month countdown is the most dangerous period of your financial life. This isn't just about exchange rates. It is about the extinction of the system you rely on to feed your family. To understand the gravity of this moment, we have to look at the scoreboard. Gold sitting at $5,000. An ounce is a number that screams. Let's rewind the tape. At the turn of the millennium, that same ounce cost you $280. By 2020, it was $1,550. Last year, in 2025, it hit $2,650. And now, as we stand in January 2026, we are at $5,000. That is a vertical ascent of nearly 1,700% in 2 decades and an 89% explosion in the last 12 months alone. But do not mistake this for a speculative bubble. This isn't day traders on Reddit or tech brothers gambling on momentum. The buyers driving this price are the most conservative, risk-averse entities on earth, central banks. These are the institutions responsible for national survival, and they are panic buying metal as if the exits are burning. For 3 years straight, they have purchased over 1,000 tons annually. In 2025 alone, they added another 100 tons on top of that. Why are the architects of the global economy hoarding gold? Because they are looking at a balance sheet that makes no sense. They know the math behind the US dollar is broken. Consider the milestone we just passed. For 30 years, the U.S. Treasury bond was the pristine collateral of the world, the safest place to park money. As of this week, that era is dead. Global gold reserves are now valued at $4 trillion, eclipsing the $39 trillion in treasuries held by foreign entities. The guardians of global wealth looked at a paper promise from Washington, D.C., and a bar of gold, and for the first time in a generation, they chose the metal. This is a vote of no confidence. It is the geopolitical equivalent of a bank run, but the depositors are sovereign nations. They are effectively filing for divorce from the American financial system before the house gets foreclosed on. Look at who is leading the exodus. China sits at the center of this shift, while their official books claim 2,264 tons of gold. The shadow data imports and covert purchases suggests the real number is north of 5,000 tons. They are aggressively swapping paper for hard assets. Simultaneously, Beijing has slashed its exposure to U.S. debt by nearly half, dropping from a peak of $13 trillion down to $680 billion. They have offloaded $600 billion in American promises in under 10 years. Russia has already left the building. After the West weaponized the financial system in 2022, Moscow liquidated 99% of its U.S. bonds, dumping $150 billion until they held less than $10 billion. They moved everything into gold, increasing their stockpile by 1,500 tons since 2014. They saw the storm coming a decade ago. The contagion is spreading. India bought 200 tons last year. Turkey, Qatar, Poland, Singapore, they are all scrambling to trade dollars for bullion. Even Japan, America's staunch ally and financial partner, has turned into a net seller of U.S. debt to save their own currency. The buyer's strike is global. There are 3 specific triggers driving this stampede, and understanding them provides the roadmap for the next 18 months. Trigger 1 is the mathematical inevitability of currency dilution. The dollar index is crashing despite high interest rates, which defies traditional economic logic. Usually a 5% yield attracts capital, but not when the issuer of that debt is $38 trillion in the hole. The U.S. government is burning through $2 trillion, more than it earns every year. Interest payments on that debt have ballooned past $12 trillion, costing more than the entire U.S. military machine. The revenue simply isn't there. The IRS collects about $49 trillion, but mandatory entitlements and interest eat up $4 trillion of that immediately. There is nothing left for the actual business of governing. The only way out is the printing press. The market knows the Federal Reserve will have to monetize the debt printing trillions to buy the bonds nobody else wants. This is the Weimar Germany playbook. It is the path of Zimbabwe, and the smart money is leaving before the ink dries on the new bills. Trigger 2 is the weaponization of trust. When the G7 froze $300 billion of Russian assets in 2022, they shattered the illusion of neutrality. Every nation outside the Western alliance realized that their savings were actually hostages. If the U.S. can turn off your bank account because of a political dispute, the dollar is no longer a store of value, it is a point of leverage. Nations like Saudi Arabia and Brazil realized that in a dispute over Taiwan or oil pricing, their assets could vanish overnight. Trust is the only thing backing a fiat currency. When you destroy trust, you force nations to seek assets that cannot be switched off. You cannot sanction physical gold sitting in a vault in Shanghai or Mumbai. It is the ultimate sovereign shield. Trigger 3 is the undeniable chaos in Washington. We have reached a point where major European pension funds, conservative boring money managers, are issuing press releases stating they are dumping U.S. debt because they view the American government as unstable. With a debt-to-GDP ratio menacing 128%, we are entering the death zone where historical empires consistently fail. This brings us to the mechanism of the collapse. We call this the doom loop here at the Economic of Fallen Empires. We are currently in stage 1, the demand cliff. The fallen whales have stopped buying. This leads to stage 2, the yield spike. As demand evaporates, the government must offer higher interest rates to attract money. Yields on the 10-year Treasury will climb past 55%, then 6%. This explodes the interest expense, widening the deficit further. Stage 3 is the pivot. When the auctions fail, the Fed must step in as the buyer of last resort. They restart quantitative easing, creating money from thin air. Stage 4 is the flight. Once the world sees the Fed monetizing the debt, the dollar loses 30 to 40% of its purchasing power in a matter of months. Inflation roars back, not at 3%, but at 15% or 20%. Stage 5 is the gold supercycle. As the currency dies, capital flees to safety. Based on the current velocity, we are looking at a critical window. Right now in Q1 2026, we are seeing the warning signs. The acute phase of this crisis is projected to hit by mid-2027. You have roughly 12 to 18 months before the trap snaps shut. So how do you insulate yourself from a 40% devaluation of your life savings? First, you need exposure to physical reality. If you do not hold gold or silver in your own possession, you are exposed. We are not talking about paper ETFs or mining stocks. We are talking about metal you can touch. A 10% to 20% allocation is no longer investment advice, it is survival insurance. Even at $5,000, gold is cheap compared to where it goes when the dollar breaks. Second, you must build resilience outside the banking system. This crisis will spill over into supply chains and social stability. 3 to 6 months of food, water, and essential goods is a baseline requirement. Build a network of people who have tangible skills, medicine, construction, mechanics. In a systemic failure, community is the only currency that matters as much as gold. Watch the dashboard. If you see the 10-year Treasury yield breach 55%, if you see the dollar index crack 95, or if the Fed announces a temporary liquidity program, that is the bell ringing. That is the moment the slide accelerates. The British pound didn't lose its status overnight, but once the momentum shifted, it never came back. The US dollar is losing that status at 10 times the speed. The central banks have shown their hand. They are selling the past, dollars, to buy the future, gold. They have the inside information, and they are acting on it. Gold at $5,000 is just the opening act. The real show begins when the panic sets in, and we see prices of $8,000, $1, 2000, or higher. You have a very narrow window of time to position yourself on the right side of this wealth transfer. Majority will freeze and watch their purchasing power evaporate. A minority will prepare. Your actions in the next 90 days will define your reality for the next 10 years. If this breakdown has helped you see the signal through the noise, make sure you're subscribed. In our next broadcast, I will be mapping out the specific month-by-month timeline through 2027, highlighting the exact trigger points you need to watch. Do not get left behind.